All right, sell mutual funds to buy Apple stock, or sell Apple stock to buy mutual funds.
We're going to start off with Scott this hour in Fort Lauderdale. Hey, Scott, how are you?
I'm good, Dave. How are you?
Better than I deserve. What's up?
So I work for a company that I get 10% of my salary, the ability to purchase company stock. The stock has been very, very fruitful over the 10 years that I've worked for the company. The way our stock purchase works is that we get to purchase the 10% of our salary twice a year in a 6-month period at 15% below the lowest point in that 6-month period.
That's how you get rich. Concentrated bets in a well-established company and getting them at a discount, so you're getting ownership.
So the sometimes when I get the stock at the 6 months, it can be $40-$50 a share better than the market value at the time.
Bro, sign me up. So I need a company. I want to work for a company like that.
I read Baby Steps Millionaire and The Money Makeover. You talk more about putting your retirement into mutual funds. I've kind of considered that 10% as being my part of my retirement. I take 16% out of my total salary with 6% in a 401k that my company matches.
Okay.
And then the other 10% is in company stock.
Okay.
And the stock has done nothing but gain in the 9 years that I've been there, and it's some big jumps as well. So do I leave that in there and consider that still 10% of my retirement, or do I switch it like you talk about in The Money Makeover to mutual funds?
Well, congratulations. Sounds like you've hit a home run, man.
He has.
It feels kind of good. And so, yeah, your theory has not been stress tested yet. And that'll come along. Okay. First, let me give you a couple of observations first. Number one, your company stock purchase plan is no different than most of them. They're almost all exactly what you described. 15% below, lowest of the 6-month average, whatever. Okay. And so it's not like you're getting some huge discount that other people that work for a publicly traded company with stock options don't get.
He's getting a huge discount on something that's rocking and rolling, right? Like, he signed me up. You want to give me 50% off NVIDIA? I'll take it.
Always exactly what you outlined. Very, very similar, if not. So it's good, but it's not the biggest deal. In most cases, if you look at a 52-week high, 52-week low on the charts, you will see a move of most stocks more than 15% up or down. And so that 15% discount can, as you said, because it's down, cause a great purchase price, but also can cause, it can evaporate in about an eye blink.
Yes.
Just because of the normal volatility of stock.
This is the great conundrum, right? Like, all right, I've amassed a pool of wealth. Do I move a certain portion of it into like a defensive strategy to preserve what I've created? Or do I just let it ride, right? Like, I have a couple of friends that have tons of money, like in one position, one stock that they work for. And it's like, ooh, then you're watching every day intraday trading. Like, it's down 25% today. Like, that 500,000 that you have is now 300,000. Like,
observation number one. Observation number two, single stocks are more risky than mutual funds.
Yes, but single stocks is how you get rich.
Okay.
Period. No exceptions.
Yeah. Yep.
Because you're violating the diversification rule of, you got all your eggs in one basket, or at least that number of eggs are all in that one basket.
See, Stan Druckenmiller, billionaire investor, was like, I don't believe in diversification. I believe in having one or two baskets and all my eggs in those baskets, and I watch those baskets very carefully. That's one approach. Not for everyone, but people do it, and that's how he gets insanely rich.
So you're taking more risk, even though you've had the benefit of this company doing very well. It's gone up, gone up, gone up. I'm happy for you. I'm glad it went up. I don't want you to have hard times, but that can gloss over the fact that you're taking risks because you haven't had a loss. You've not anything that scared you, that woke you up and went, oh, this is risky. So what we tell folks to do, our standard rule of thumb is don't put more than 10% of your net worth in single stocks. And you currently have more than that with the formula you're giving me.
Okay.
So the example of that always comes back to my mind was many years ago. I was coaching a lady that had worked for Procter & Gamble, which is a fine company. She had $800,000 in her 401k. It was all in company stock.
Yeah, see, in a case like hers, I would agree with Dave, right? You got to get that out of there. You got to diversify that. Because she's probably not like a great investor, right? So that 800,000 was not luck, but it was discipline, right? So then we need to transition to another disciplined level of just preserving. Because 800,000, man, you do not want to go back to 100K or 50K after that, right? Like that would be tough pill to swallow.
It went in half the year she retired.
Yeah, exactly.
So I don't. None of my 401k is in. I work for Apple. Is in Apple stock.
Oh,
see, this is the exception to the rule, right? Like Apple, do we think Apple in 10 years or 15 years will be a larger part of the economy than it is today or smaller? I'm betting larger, like more than likely.
That's a wonderful stock, yeah.
Yeah,
the
he
stock
just
purchase is a
changes his
total separate
tune.
deal. And to be honest with you, Dave, I haven't. I'm recently divorced a couple of years, and I was lucky to get out and be debt free. And you know, I've never really read your books because I never had any. I didn't have any debt. But after watching you with Robert Morris, I downloaded the first book and then went to the second book, and it really motivated me to kind of get my act together.
Yeah. Well, so Ecclesiastes says, "Spread your portions to 7, yes to 8, for disaster may come upon the land." And Apple is about as it's about as wonderful a single stock story as there is on the planet.
Yep.
Yeah.
It's doubled. It's doubled.
Yeah, it's crazy.
Over the 10 years.
Wonderful.
I did have to get rid of some of it.
They have more money than Egypt. They really do.
I don't know what.
I had a friend's father that had made millions in Apple, and every year for 15 years, his advisor would be like, you got to sell a portion, you got to sell a portion. He just let it ride, and he's built a huge portfolio doing that.
They actually have more cash than Egypt. It's an incredible company.
Yeah.
Hey, you mentioned you
Truly.
read the first 2 books and that you originally had kind of stayed away because you weren't in debt, but I recommend you pick up Baby Step Millionaires.
He did. That's what he's talking about.
Oh, perfect.
Oh, I did. I read both of the books. I've actually listened to probably 3 times each.
Well, thank you. So the whole question is, how much risk do you want to take? And I think we can all stand up and cheer and say Apple has done a wonderful job. Of all the single stocks out there, it's the one that might be the most tempting. It is an unbelievable story.
I would like, how do you sell it? It's Apple, you know what I mean? It's like you're selling Michael Jordan to pick up a bunch of like B-level players, like
But I'm just risk averse enough to say, okay, I'm going with the scripture says, spread my portions to 7, yes to 8. I don't want my whole deal on one company.
Yeah.
And you don't have your whole deal, but you got a lot of it. Yeah. And so I'm probably going to be a little less Apple prone if I'm you. If I was ever going to do what you're doing, it would be that company. Oh my God, it's wonderful.
My personal opinion, you should just let it ride. I use Apple products. I'm talking to you from a MacBook. I got an iPhone. Like I just don't see any real competitors, at least in the U.S. market, long or short term. You know.
Okay. So if you want to keep doing it, keep doing it. I just want you to hear. I want you to feel that you're violating the diversification principle, and that does nothing but increase risk inherently in that. One bad iPhone launch, one bad lawsuit over a tablet or whatever. I don't know what can happen. I mean, I have no idea what can happen.
No, their biggest threat is the Chinese competitors, right? China, I think Huawei has a better phone. Like I use this OnePlus is a Chinese company. I have as my secondary phone. Great products, honestly. That's their biggest competitor. But do we think that the U.S. will allow these companies into our markets anytime soon? Probably not. So they do have a moat, which is the government.
But they get cancel cultured. I don't know how this works, but whatever it is, I just don't want. It's not in your control.
Yeah,
you're one of a bazillion employees. You don't control this stock, and so I wouldn't be as heavy in it as you are, but I will acquiesce and say if I was ever going to be. Good Lord, there, the financial regardless of what you think of the products or the people or anything else, the financials on that company are blistering
spectacular.
Good.
Yeah, that's a great position to be in.
It's
good
crazy.
Company. Yeah,
it's crazy how much cash they have. It's mind blowing. But aside from that, I still. Well, I mean, I'm sitting here saying how much I'm a fanboy of their stock, and I don't own a single share. That says
it's it's like the classic debate, right? These concentrated bets is what produces really makes you rich, makes you wealthy, right? Diversification kind of smooths out any bumpy roads, but you'll never get explosively wealthy quickly, right? It'll be something over the course of 10 or 20 years, which is the correct path for most people, right? Apple might be just the canary in the coal mine, the one off in this case.